Traders Corner is proudly brought to you by IG, the specialists in CFD trading.
Welcome back. You're watching Traders Corner, and the incredible power of the TV pre-record means that as you watch this, Garth McKenzie is in fact sunning himself somewhere on a beach in Mauritius. Lucky you, Garth, when this does go to air. But tonight we're going to talk about some sort of Technical Analysis 101. Frans de Klerk and I have a show on Thursday evenings. We often use the terms bullish engulfing candle, bearish engulfing candle, dojis, morning star. So this is candlesticks and reversals, and this is the theme of tonight's show.
Yes, that's it. It's a bit of an educational show, as you say, because I'm away right now, somewhere in Mauritius. So this has got a bit of shelf life, and it's something we can probably refer back to in future. And you know, I put the question out there to my subscribers on traderscorner.co.za to say we're going to do an educational show. What would you like us to talk about? And this issue of reversals came up quite a few times. And we haven't discussed it in any great length on this show before. No. So I thought, let's do it. Let's put this together and actually show what a reversal really looks like.
Okay, well, let's start off with the candlesticks themselves, so to speak. And they are fantastically named. I'm not sure who came up with the names for all the candlesticks and the reversals, but let's start off with the bullish and the bearish. Those are the two types that you get.
Yeah, that's right. So these are the two most basic types of candlestick patterns that you get: the bullish candle, the bearish candle. And these candlestick patterns were originally invented by the Japanese, actually, to monitor rice prices. And, okay. And since then, they've evolved because they can be applied to anything with a price that moves. So now it's very popular to use these to plot share prices and indices and things like that on the stock market. So if we have a look at these two types of candlestick patterns, let's quickly have a look, first of all, at the bullish candle. Now, the bullish candle is typically a white candle. If we look at these two, we're going to look at the bullish being a white or an open candle, okay. And the bearish being a black candle. Some people have settings different on their computers. They might have the bullish candle being green and the bearish candle being red. You know, you can adjust these things. But for simplicity, I like looking at them as either black or white because it's also much easier to see them more clearly. Okay. So if you have a look, now the bullish candle represents the following things. You can see the opening, which is the bottom left of that box, if you like. Then you've got the daily high and low, represented by the wicks of those candles. And you can understand now why these things are called candlestick patterns, because it's got a body and it's got a wick on either end. Yeah. So the low is represented by that bottom wick. Some people call that a shadow, the upper shadow or the lower shadow. And then you've got the high being demarcated by that upper wick. And then the close, at the end of the day, the close is higher than the open. Okay, so that means effectively you can argue that the bulls won the day or the buyers won the day.
Okay, in other words, the share was bid up during the day.
Yes, that's right. That's it.
And the close, what if the close and the high were at the same points?
Then you would have no wick at the top here. Okay. You would simply have you would have your close and your high being the same thing.
Okay, so the high would represent the intraday high that the share or whatever it was got up to, and the close, if it's slightly lower, where it closed at.
Correct.
Okay,
that's right. Now, if we look at the bearish candle, it's quite similar, but the opposite. So your open is up at the top left now. You've got your high and your low in the same place. But the share price now closed lower on the day, closed lower than the open. So therefore, that's a bearish candle. And you could basically argue that on either of these candles, who wins the day? If we're talking about a daily chart here, who won the day? Well, on the bullish candle, the buyers won the day because they managed to push the price up into the close at the end of the day. On the flip side, on a bearish candle, the sellers won the day because they managed to push the price down from where it opened to where it closed over the course of the day. So those are the two major types of candlestick patterns. But then what if you get something like this, where you've got your opening and your closing being at the same price, and then obviously you've got your high and your low? What is that? Now this is a candle called a doji. It's a good Japanese name. And that is where your buyers and sellers, you could argue, are effectively in equilibrium. There was no one or other force that won the day. The buyers couldn't push the price up, the sellers couldn't push the price down. At the end of the day, the share price opened and closed at the same level, and that's what we call a doji, and it represents equilibrium between buyers and sellers.
Okay, so those are the three main types of candlesticks.
Yeah, that's right. Those are the three most basic types of candlestick patterns, and all reversals and all the other interesting things ultimately are some sort of a derivation of one of these types of candlestick patterns at the end of the day.
Okay, well, let's get into some of those derivatives.
Yeah, so I'm going to show 4 types of reversals here. We're going to do 2 bullish reversals and 2 bearish reversals. Now, the first concept that I've got here is what's called a bullish engulfing candle. So if you have a look on the left there, you've got a bearish candle. But then the day after that comes along, and you can see that the body of this whole candle engulfs the previous day's body, and it's a bullish candle. So that is a bullish engulfing candle. What it really indicates to you is that on this first day, the sellers obviously were in charge. They managed to push the price down. On the second day, the price actually opened weaker. So it opened in negative territory. It might have even traded to a slightly lower low that day. But by the end of the day, the buyers had come along and they had pushed that price up so aggressively that they managed to close the share price above even the previous day's, top of the previous day's range. Now, that's what we call a bullish engulfing candle. And that is a very positive thing. It's a reversal in the sense that it shows that the buyers have really come along and overpowered the sellers to take the price of the share higher.
So, and it's called a reversal because it moves off a weakened position
Yes.
and changes the direction of the trade.
That's right. And what's important here, and why we always talk about reversals, is because if a share price is falling, we always say don't try and catch a falling knife, or don't try and catch a falling piano. Wait for some sort of evidence that you've got a reversal in place. And this is what it gives you. This is telling you that, well, now the buyers collectively have come along and they've actually shown that they now are the stronger force. That's a reversal. Now's the time to get on board. You're not catching a falling knife if you buy this now.
Or a falling piano.
Or a falling piano, exactly. Now, so how do you trade this? Well, the safest way is to then wait for the next day and buy on a break above the top of the bullish engulfing candle. And then you would set your stop loss down below the lowest point of that reversal.
Okay.
And typically if you do that, you'll be relatively safe. The likelihood then of this low being breached is actually significantly reduced because you've already got the indication that the buyers are the stronger force here.
Can you just go back to buying on the break of the high? So the break would be the point.
If you see the top of the wick here on the bullish candle,
Yeah.
that's effectively the high of that day.
Okay, and that's the level, not at the close where you would buy it.
Not necessarily at the close. Look, you don't know where the price is going to open or close the next day.
Okay.
But if you see continuation of the buying, then you should see it taking out that bullish day's high, and that's then your safest time to enter.
And then I suppose the reverse is true, isn't it?
Yeah, the reverse will be true. But let's quickly have a look here. Now, this is an example that I've got on British American Tobacco, just to show you. I've got examples of each of these reversals. Now, this is a support zone we identified some time back. It was at 510 Rand on British American Tobacco. And what you can see over there, that's quite clearly a bullish engulfing candle. That candle engulfed the prior day's body. And as you can see, that was then the start of a significant move higher. So had you used this technique to then allow that as your entry signal, you would have been safe. You wouldn't have been stopped out, and you would have managed to capitalize on that huge move higher.
And presumably you wouldn't have been put off by because it looks like the next 2 days fairly bearish trades, because they didn't ever drop below the point at which the low of that bullish engulfing candle.
Exactly. So your stop loss would never have been triggered here.
Okay.
You would have been, yes, you might have sort of wondered, is this the right thing for 2 days? But reality, your stop loss never got touched, and the share price moved nicely higher after that.
That's a lovely example. And then what about the reverse?
All right, so the reverse is a bearish engulfing candle. So now, whereas the previous one was a buy signal, this we would look at as a potential signal to go short or to sell. And the opposite is true. So you've got a positive bullish candle, then followed by a bearish candle. And that bearish candle indicates that now suddenly the sellers have overpowered the buyers, and they're now pushing that price down. And there you can see the power of the two candles, the bullish being up, the bearish being down. How do you trade this bearish engulfing candle as a reversal? Well, what you would do if you wanted to go short, and you saw this as a signal to go short, you would then sell short on a break below the lowest point of that bearish engulfing candle, and then you would set your stop loss above the highest point of that bearish engulfing candle.
Okay.
And also, again, by doing that, you're waiting for an indication that the sellers have actually started to take the lead. Yeah,
okay.
That's right. So if we look at an example of this, now this is a more recent example in Bidvest, and we actually did a trade in Bidvest, but although we did a long trade sometime later. But for a while there was a range, in fact it's still intact generally speaking, between 280 Rand and 300 Rand a share. Now up here at 300 Rand you can see there's the resistance zone, and over there we got a bearish engulfing candle on Bidvest. Now had you used that as a signal to go short, you would have put your stop loss above the top of that reversal, which was never violated, and there you can see the share price traded lower and lower, basically back into the bottom of that trading range. So it was a nice example of how you can use a bearish engulfing candle as a reversal signal to enter a short trade.
After which you had a bullish engulfing candle.
Yes, that's right, well spotted. So down here at the bottom, and in fact this was the one we traded for the TV show.
Okay.
At the end of September. We traded off of that bullish engulfing candle, looking for a move back to the top of the range.
It's finally starting to make a bit more sense now. Garth, and you also have things like morning stars and evening stars.
Yes.
So what is a morning star and a morning star reversal at that?
All right, so the morning star reversal is comprised of 3 candlestick patterns in succession. So the first one, as you can see on the left here, is a bearish candle. Then you've got a doji, and then you've got a bullish candle after that. So what it's saying is that over the 3 days, you've got sellers being in control. Then there's this period of equilibrium where the sellers and buyers are kind of matched in their strength, and then you've got a bullish candle, which indicates that the buyers have actually now taken the upper hand in this tussle, as it were. And there you can see that green arrow basically indicating that the buyers have now taken the upper hand.
And when we talk about Morningstar, and this is probably going to sound like a really stupid question, but does this mean that it's a trade that would start off on that day's trade, so in the morning per se, or is it simply the arrangement of the candles?
Yeah, it's just the arrangement of the candles.
Okay.
That's got nothing to do with morning or night or
well, that's
afternoon.
very confusing. Okay, so then what's an evening star reversal?
No, hang on, let's firstly look at the example here and how do you trade this. So what you would do after the morning star reversal has happened, you would then buy on a break above the high of that bullish candle in the morning star reversal. You'd set your stop loss underneath the lowest point of those 3 days, all right? And the likelihood of your stop loss being breached is pretty low when this happens, because now you've already got an indication that the buyers have got the upper hand here. So if we look at an example, a nice one recently was SAB Miller. And we identified that there was this lateral support zone at 560 Rand. And what you see over there is a very, very clearly defined morning star reversal. You've got your bearish candle followed by your doji, followed by a bullish candle, and that then gave rise to a nice, what we've had about a 70 Rand increase in the share price of SAB Miller since then. And your stop loss would have been below the lowest point of that reversal, and as you can see, that stop loss has never been breached.
Okay, so then an evening star reversal would presumably be exactly the opposite.
So an evening star reversal is the opposite. We're basically looking at this as a sell signal now, as an indication of potentially going short. So there you've got the 3 candles again, but this time you've got a bullish candle followed by a doji, followed by a bearish candle, indicating that the sellers have now taken the upper hand in this fight over the 3-day period. And the way to trade this, if you spot one of these and you can see it against resistance, you would look to short a breakdown below the lowest point of that bearish candle, and your stop loss would then be above the highest point of the 3 days that constituted that evening star reversal. So if we have a look at an example here, Vodacom gave an example of an evening star reversal quite some time back actually. But what we spotted at the time was that there was this lateral resistance at 129 Rand a share, and we then got the 3 days, a white or bullish candle followed by a doji, followed by a bearish candle. And that's your evening star reversal, and that did ultimately result in the share price moving lower. So had you used that as a signal to go short, you would have actually been, you would have done quite well there.
And Garth, do you find these are really strong and reliable signals to use as a trader?
Yeah, generally I do. I'm a big believer in using reversals and waiting for reversals. But what you must also remember is that you don't use a candlestick pattern just in isolation.
No.
You want to also use it with other technical factors as well. And you'll notice on all of these examples I gave, I also identified a support or a resistance level to combine with the reversal as well.
Okay, Garth, we have to leave it there. Fascinating. And this will be on the web, so if anyone wants to refer to it, they can. Thanks, as always, for joining us on the show. That is Garth McKenzie, founder and editor of Traders Corner.
Traders Corner is proudly brought to you by IG, the specialists in CFD trading.